Okay, many thanks to our three authors for leading us off. I want to start off with one question, and then we'll open it up to the group. My question relates to the China dimension of your argument. It's only one piece of it, but it's an important piece. Suppose China had been following your rules, had avoided controls on inflows, so presumably would have gotten more capital inflow. Why wouldn't the People's Bank of China simply intervene more in the currency market, build up their reserves even more, and still limited appreciation of the exchange rate? Would you argue that at some point the monetary effects would have swamped, or do you have some other reason to think that your proposal would have solved that particular problem?
Well, I think it would have made it more difficult for China. Can't hear you back there. It would have made resisting appreciation more difficult for China. But I would also include in capital account policies reserve accumulation. So this set of rules that we are talking about is not only about capital controls. It's about capital account policies defined in a broad way and including reserve accumulation. And so I think with a good set of rules, China could not have increased reserves more as you assume. Okay. Arvind, you want to say anything about that?
No, I agree with what Olivier said. Just make it much more difficult for China to do. I mean, you know, in principle, one can't shut off all the options that countries have. They have infinite levers, perhaps, but you know, all we can do is to try and circumscribe as many as possible.
Yeah, and yours would push the incentives for China in the right direction by making it more difficult, more costly. Okay, floor is open. Yes, please identify yourself. Either use a traveling mic or go to the standing mic in the back and then fire away.
Yeah, Amar Bhattacharya with the G24. So just wanted to pick up on what Arvind was saying, which is why are emerging markets reluctant to have such a system of the kind that you suggest. And I say that being very sympathetic to the analytical case that you make for a more regulated system. So I'd say the first argument is really a balance between the source side of the problem and the recipient side of the problem. You know, as well known, the main driver of capital flows are global conditions, risk aversion, liquidity, things that are in the hands of a few. So if you're talking about regulating of China, you know, what about regulation of the United States? So question number one. Second, wanted to say that, you know, we should not be so obsessed with China that we build an entire regime around one country. So that spillover, which is exchange rate misalignment or manipulation or whatever you want to call it, why not take it head on and say, you know, we need a better regime for exchange rate coordination, which is what the IMF is charged to do, and let's address that. I doubt whether allowing Chinese banks to borrow a whole lot of money and lending it domestically would have been the right thing to do. Third, there is really no evidence, significant evidence of spillovers. Yes, Christine Forbes's work shows there are some spillovers, but there's other work that shows that there are no significant spillovers. And you know, if you take the theoretical argument, if there is a negative externality, there is every basis for a tax. And the final reason why emerging markets do remain reluctant, it has to do with the imbalance in the governance of the fund. And therefore, there isn't a sense that in the end you will get fair play. So at the moment, you know, we would still, you know, call for the degrees of freedom rather than restrict them in the way that, you know, the book proposes.
Yep.
You went to several questions.
Yeah, you want to answer? I have answers to a couple of them. Yeah. just respond to two aspects of what you said. So Amar, we're in agreement on the need to change the governance of the fund. That's fundamental. But that's I would say, you see, just as an aside, let me just say about the governance of the fund, because what is the word, fire on all sides, or what because I think part of the problem clearly is the fact that the industrial countries are not letting go. Clear. I think that's a problem number one. But I think problem number two on the other side, which I think is being underemphasized, is that when the opportunity comes to actually, hold the industrial countries their feet to the fire, I think some of these emerging market countries and BRICS evade and duck their responsibilities. And I think let's not forget that aspect. So governance is both sides. On, don't be so obsessed with China problem. I think Joe Gagnon, for example, has shown that this whole accumulation of reserves and the mercantilism is not actually confined to China, but it's a broader East Asian problem. And so in that sense, although it's perhaps a little bit unfortunate that if we presented it as a kind of proposal in search of getting China to behave, it's actually, its appeal and its relevance is much broader than that. Last point about, exchange rate, this seems to be like an indirect way. Why not just do exchange rate coordination? Yeah. And the answer is obvious. We've tried exchange rate coordination. It hasn't worked. The IMF is completely ineffective. The US has been ineffective. Bilaterally, multilaterally, Fred disagrees with that. But so the point is that, and I think we need to do everything. For example, Aditya Mattu and I have a proposal on, actually exchange rates, calling them, deeming them to be subsidies and import tariffs. So this should be seen as part of a broader international effort to get at, what seem to be similar kind of problems.
Okay. John, go ahead. Sure.
I want to make one comment, maybe two comments. First of all, about the question of whether the United States should also be involved in coordinating. The case is whether there should be a tax on capital outflows from the US to accompany something like QE2, which was very inconvenient to the rest of the world without a tax on capital outflows, and I think there's been a good case for that. So in that case, I would say yes, that the United States should be subject to the same rules, and it could have been inconvenient. The other thing I want to pick up is the question of Kirsten Forbes' finding that there were spillover effects from capital restrictions, capital account restrictions in Brazil. Now, you say that some other people looked for it and failed to find an effect. But I think that on theoretical grounds, there's an overwhelming case of the presumption that if capital account restrictions works somewhere, then it's going to have a spillover effect on others. And the fact that one researcher found it is therefore sufficient to make the case that one should at least open the possibility of having a joint action.
But I took it your point was that if there were spillovers, the countries suffering from the spillovers could put on their own tax.
Exactly. If I want to inoculate myself against a virus, if the virus can go elsewhere, other people can inoculate themselves.
Yeah. Well, it's
exactly. I mean, in the sense that I'm doing it because to deal with an externality that creates a spillover.
But then to be a little pejorative, one can conjure up the notion of competitive beggar thy neighbor capital controls analogous to competitive beggar thy neighbor trade controls. So it's a little bit the same as, well, country A puts on import quotas, and so the goods go to somebody else, and he puts on import quotas, and you go up the line. So that's, I think, the case for their international agreement.
Yeah, exactly.
John, I wanted to challenge you a little bit, or draw you out more on your point with the U.S. and QE2. but it's in the sense of trying to make sure we all understand your proposal. Are you all proposing that when a country takes macroeconomic policy measures, monetary policy measures, fiscal policy measures, and one result is an increase or decrease in its international capital flows, that it's then incumbent on that country to put on capital controls that avoid that international impact that is adverse on somebody but may not be adverse on everybody? Go into that a little more and explain how you conceptualize that, let alone how it would work in practice.
It's not something that we've discussed between ourselves, and so I'm talking for myself and not necessarily for my co-authors. But I would envisage this as a question for the IMF. The IMF then has to decide whether it's adverse for the majority of developing countries, majority of other countries. I don't think one can one can hope to have unanimity. The same answer would not apply across the board, but the United States should do what's in the interest of most other countries.
Well, let me ask your co-authors if they agree, and maybe ask Joe Gagnon in the back, who I don't think agrees. But does anybody else want to hold forth? Because I must admit, and I've read this as it's been prepared, I myself had not quite understood that it had that far-reaching an implication.
No, I don't think it necessarily has that implication, but Emma asked the question. I was trying to answer it.
Joe?
Well, I actually haven't thought of it this way, but I'll just make 2 points. One is that if you look at magnitudes here, the magnitude of marginal flows that could have been caused by quantitative easing 1 and 2 together out of the U.S. over and above what would have happened otherwise is almost certainly less than $100 billion, which is less than 10% of the U.S. assets that are being bought actively by foreign governments. So it's really quite a difference in scale here. I think the other thing would just be to say, well, where do you draw the line in terms of where the IMF can be making recommendations with teeth into what governments can do? And I would have thought that a natural thing would be on cross-border flows out of the government itself, but that you're talking now about private sector second-hand things that the government that respond to what the government does. Gee, then there'd be a whole bunch of things that the other countries would be doing too. I mean, that just seems too complicated to get into.
Okay, there were lots of other hands. Welby.
Thanks. Welby Lehman from Ways and Means Trade. Dr. Subramanian correctly pointed out that there's some pressure on the trade agreement model that we've used, which has a very substantial exception for monetary policy and has a very light touch on tax policy, allowing very substantial flexibility in both regards, and then has this famous prudential exception, which at least everyone agrees can be applied to the banking system, let's say, with regards to, let's just use a traditional thing like reserve requirements. So in that context, why do we really need to put pressure where, for example, the long set of academics, and for that matter, the Levin-Frank letter puts it, which is prove to us that the prudential exception can also be used specifically for this. If there's flexibility with regards to monetary policy, tax policy, and reserve requirements, why do we need anything else?
So that's an excellent question. I guess my response to that is that, these agreements are kind of legal agreements and therefore are justiciable, right? And so having been in the WTO and the GATT and seen how dispute settlement works, the point is that, you can't be sure that, they will kind of provide the kind of permissiveness and leeway that because there is scope for ambiguity. So this is just a plea to kind of eliminate any residual ambiguity there might be. You may well be right on the substance, but you can't be sure that you're right. And it's to eliminate that ambiguity, which can be a problem when it comes to dispute settlement. I think that is my interpretation of what this plea is all about.
Okay, Jean-Marie.
Thank you. Jo Marie Griesgraber, New Rules for Global Finance, and I just wanted to say how much I agreed with your response, Arvind. Several non-governmental organizations have been very concerned about the inconsistency between what the U.S. is saying, especially in its bilateral trade agreement, the ambiguity in the WTO agreement, and yet in the Financial Stability Board, and even in the IMF, there's greater call for policy space. So I'm delighted with what your report is coming out with. I wanted to go back to refer to two things. One is, even if the IMF is ambivalent or there's ambiguity there, it's in their articles that they can't touch it. So, countries have a strong platform to stand on when it comes to opposing the stopping of capital controls. You have the right as a country, according to the articles, to use capital controls to restrict financial flows, which hasn't been changed, which is an alleged reform that was stopped. What I would like to check on the QE 1 and 2 and possible 3 is whether or not the tax would be a benefit to the domestic market, because part of the problem is the lack of lending in the United States. And it seems to me, even though it's a mere $200 billion, which is small on the global scale, nevertheless, if it were taxed, it would discourage outflows and possibly encourage domestic investment, which is very slight at this time. And I think your work is extremely interesting. Good luck with that internal IMF, what can we say, politicking?
Yes, no, there is an argument that it's good to have no rule because no rule gives freedom. But we also developed the view in the book that actually rules give freedom. If you have no rule, you don't know what to expect. There is stigma attached to the use of capital controls, and so countries might hesitate and might not use them to the full desirable extent. And rules could actually allow more countries to use more the justifiable prudential capital controls. I think it's very important in our proposal that developing this set of rules under the auspices of the IMF does not mean going back to the debate of the 90s. This debate about giving the IMF jurisdiction over the capital account, which at the time was understood to mean to promote capital account liberalization, which was assumed at the time to be favorable to growth in the same way as trade liberalization had been, and this idea that capital account liberalization was the next frontier. I think we are past this we have passed this view, and if the IMF were given a mandate to develop such a set of rules, I mean, the mandate would have to make it very clear that the objective is not free capital mobility even in the long run, and the objective is to define what is good practice in the use of prudential capital controls. And conditional on that, if that is made clear and credible, I don't see why emerging market economies like Brazil would be reluctant, because in particular, I don't see how such a set of rules would have constrained Brazil, what Brazil has done since 2009. It would have not, in my mind.
And I just want to go back to it's kind of what Amar asked and John responded. I think unfortunately the drawing the equivalence between what the US does by way of QE 1, 2, 7, 8, 9 and what China does, that equivalence I think is being used, I think, politically not to want to seen to be violating intra-BRIC or intra-emerging country solidarity, because the analytics I think is clear on this. This goes back to Tinbergen and the second bit that some instruments are closer to some objectives, and monetary policy is geared to domestic objectives, and sure there will be some incidental or collateral thing, but the point is that if you believe in this targets and instruments theory of the world, then if you say that even though this is being used purely for domestic policy reasons, but you nevertheless want to curtail it because of the collateral thing, then that I think risks becoming overly intrusive, and I think that's a problem.
We have a question up here, and then we'll go to Ted in the back.
I stood up, Bill. Thank you. You're proposing
Please identify.
sorry, Eduardo Fernandez Arias, Inter-American Development Bank. You're proposing a dual system. Given what we know, it's very clear that there is a role for capital account controls for prudential reasons. At the same time, all of those can be used and abused as a protectionist device. You come up with a dual system in which some flows are of the sort of good type and would not be taxed, and others are the bad type and may be taxed. Now, with all dual systems, I can then predict that lots of flows will come in disguise as good types in order to exploit your proposal. So, in fact, you're very brave in putting in writing what any model would tell you, that capital inflows are an optimal policy, perhaps, if you avoid this disguising problem, but you're going to have it. Actually, perhaps you should think of taxing outflows rather than inflows. Now, before you shout me out of the room, I'm not proposing expropriating anybody, just as a contractual stipulation ex ante, as you're proposing these inflows, but focus on outflows. What will happen then in the condition of sudden stops, which was your premise for the prudential reason? What will it happen then? Well, it will act as a tax on inflows only for those inflows which are coming in with the expectation of being coming out in the case of sudden stop, and not otherwise. And that is exactly what you want to achieve. So maybe you should think as a tax base, not the inflows, but the outflows.
I think you've made a big mistake in summarizing our proposal. We don't seek to distinguish particular inflows or outflows as being good and others as being bad, but instead to take a general look at the country and say, are its inflows as a whole too big or too small? And tax on that basis rather than tax between different flows, types of flow.
Yeah, but that means in the aggregate, they're either bad or good.
Yeah, of course.
Oh, okay. In the aggregate.
Yeah. But in aggregate is critical. And I think, Fernando, as I understood it, what you were saying was you were distinguishing good from bad on the basis of the individual flows.
Okay,
Yeah.
Ted. Well.
So in theory, it's true that you would like to tax different flows differently, depending on how dangerous they are, that is, their contribution to systemic risk. In practice, it's difficult to do for the reason you mentioned, which is circumvention. So one probably cannot in practice go as far as one would like in differentiating the tax according to the inflows, and maybe that's a reason to have a broad tax on inflows as opposed to a differentiated tax.
But just to...
Still outflows will be a better base, nevertheless.
Say it again.
Capital outflow would be a better base for taxes than inflows in any event, given that the problem, or the prudential problem, comes from the outflows in certain circumstances. And different types have different properties regarding that. So a blanket tax on inflows, which I understood now it's your proposal, though that part is not subject to criticism, would still be inferior than focusing on outflows.
Oh, sorry, can you just one? I don't want to get into the whole whether outflows prevent outflows and therefore better, but certainly the tax on outflows that you're proposing would not address that part of a proposal which relates to China, where we want actually more inflows than possible. So, where policies where too closed a capital account leads to undervalued exchange rates, and that the tax on outflows would not address it, because in some ways, in that instance, we want to do just the opposite. We want to encourage inflows.
Yes, so in the boom-bust cycle, you have excessive inflows and excessive outflows. So you want to tax inflows, you want to tax outflows. From a prudential perspective, I mean, what prudential means is doing things before the crisis comes, so it would mean taxing inflows. And in the same way as you discourage systemically dangerous activities in the boom, even in a domestic economic context. So it's essentially macro-prudential regulation. It's a form of macro-prudential regulation.
But in practice, isn't it true that most countries that have applied capital controls, either outflow or inflow, have differentiated and applied the controls to some types of flows, but not others? So they have disaggregated, and that's one of the key questions. Long-term versus short-term, direct investment versus portfolio. That kind of disaggregation, I think, has been the norm. So I guess, is it in your package to do that, or to be more macro and look at the aggregate flows on either side of the equation?
Well, I think we couldn't rule out some differentiation. Certainly FDI versus the other things, one would naturally lead to that distinction. Where again, I don't think there's it's a dangerous thing to say when Ted is the next questioner, but I don't regard that as a great problem in distinguishing FDI from from other flows.
Okay, Ted.
Well, I'm not going to take on that one, though. I think there's a big measurement problem. So that's the way FDI is not generally bricks and mortar. So I'm actually broadly, notwithstanding that comment and Arvind's comment earlier, I'm broadly sympathetic with this blue sky thinking about this stuff. But I have 6, I'm Ted Truman from the Peterson Institute for International Economics, 6, but they're short questions. And you can pick which ones you want. So the first issue, I think, is in contrast to the group that John is associated with, which proposes fully everybody should have capital flows all the time. When they don't work, you turn the screws further. That's the proposal, the Gallagher proposal, which I think is not actually reviewed in your book. So the question is, what do you think about that? And the way it's related, it seems to me, is the second question has to come with your remark about sort of the fund's staff's position evolving is as last resort. So what is that all about? That is, at least as I understand it, that's about other things may be wrong in the country. See Brazil, which has had for many decades a serious fiscal problem, right? And therefore it has weak fiscal policy and tight monetary policy and high interest rates. And so it was much better for Brazil to fix that problem than impose controls. But the Gallagher approach is just turn the dials as much as you want and so forth. So comment. Third, I would like Marvin maybe to talk about the issue of bilateral and multilateral. So one important distinction between the fund and the WTO is WTO is country to country, or a few countries in one country, right? And the fund is about all the rest of the world versus one country. And so that's a very important distinction. I mean, if you're going to do something, it's a very important distinction, since everybody would be authorized to, or so forth and so on. And it would be all against it. Comment on that, if you would, maybe. And it was unclear to me in your regime, especially John's remarks, whether you are having the fund be a referee in some sense, in an advisory role, or mandating. So in the QE2 example, right? So are you saying the fund should tell the United States adopts QE2, the fund decides, fund management and staff decide that the fund, this is damaging the rest of the world, and so the fund can vote to tell the United States to impose capital controls. That's, or to say, you've been bad boys. That's an important, I think, distinction in terms of how you're working your system. Now the provocative question is, so are you really proposing that that Europe reimpose capital controls within Europe, since that was part of the problem? And the last point I would just observe, as far as the United States is concerned, is we, of course, did this, right? We did this, as Fred is shaking his head up and down. We had for a decade or more a series of controls on capital outflows. And it was regarded by us, the United States, and the world as a complete and total disaster in a much more simple world than we have today. Take your pick.
I was glad Ted reminded everybody, because the U.S. had come up a couple of times, that the U.S. did impose capital controls for about a decade, including, of course, taxed portfolio outflows, and therefore raised the price. I don't share Ted's last point that the world views as a total disaster. I think it was more a non-event, didn't have all that big an impact. But just as a reminder that the U.S. certainly has done these things, and so not to be ignored in any discussion going forward. But you guys have a lot of questions from Ted, so go ahead.
Well, there's certainly one country didn't regard the U.S. imposition of outflow controls as a disaster, and that's the U.K., which London became a financial centre because of that.
Took over the market.
Right. But I think that in response to one of the questions, yes, this is the first question. The proposal. No, I guess it's not the first question, sorry. But the one in which you asked whether one is envisaging the IMF being a referee or not, that is certainly the way I interpret it, but it's not a question of the staff and the managing director, staff and management deciding it. It has to be subject to the executive board as well. Yeah, that's what I would envisage, that they could authorize a country to impose. Whether they could order it, I guess there are some bigger questions there.
So just to be clear, this would be a stronger rule than the current rule on competitive undervaluation or currency manipulation, where there is no authority for the fund to order a country to cease and desist.
Yeah. Well, I think it's generally agreed that the present fund rules are too anemic to support the fund doing anything effective in the world.
Generally agreed by us.
Right. Presumably it's not agreed by the people who... there was one other of the questions that I felt I had to answer. But I'm sorry.
John, wait.
No, I can't read it. I'm sorry.
Go ahead, Arvind.
Okay. So do we think that this tax on inflows should be permanent or counter-cyclical? Well, the latter. So our view is that the the optimal prudential controls would be a counter-cyclical tax, not a permanent tax. Although we talk in the book about possible reasons why some countries might want to keep, for a transitory time, some permanent, well, not permanent, but for 10 or 15 years, a base level of tax, which would be removed over time, but not following the ebbs and flows of capital. Now, tool of last resort. So here it's the IMF itself does not talk about that with one voice. I mean, the tone depends a little bit whether what you read comes from the research department or other parts of the IMF. But on average, I think the IMF position goes a little bit further than just saying, if the problem is something else, then use another tool. When I read the IMF literature, I see a long list of things and tools that you have to check whether they could not be used rather than capital controls before you think of using capital controls. And if capital controls were a legitimate tool in the toolbox like other tools, I don't see why we would make that kind of list. We would more make an allocation of instruments to objectives. But often that's not quite the way the IMF literature on that is written. Now, whether we are talking about an indicative code of good practice or something more constraining, well, in the book we talk about both, but in the end it boils down to the sticks and carrots that are going to be attached, associated with this set of rules. So what are the sticks that can be used against the countries that would violate the rules? And here I think Arvind...
Actually, I want to make a broader point, a response to the question that Ted asked, which is the supposed difference between country to country at WTO and all against one in the IMF. That's actually not strictly right, Ted, because remember, we're talking about two stages. One is the kind of, first the negotiation or the acceptance of this, and then the implementation. The acceptance or the negotiation has to be a multilateral process, whether it's in the WTO or whether it's in the IMF. I mean, if something like this has to be adopted in the IMF, a whole bunch of countries have to agree to it. So it has to be broader cooperation and not country or all against one. Now, then when it comes to implementation, then, of course, I think there are these subtle differences between the WTO and the IMF. In the WTO, you have a dispute settlement process, which is what kind of country to country initially, and in the IMF, it's more so. But I think the problem here is going to be much more, getting the rules accepted, which I think is a much more a multilateral process than country to country. And that, in a sense, determines whether the fund how the fund acts as a referee. And there I agree with what John said. But the point is, the broader point, of course, is that the fund is absolutely toothless when it comes to enforcement. Whether it's exchange rates or, if you have a code, by definition, it's not going to be something with a lot of teeth. But the point about this would be to just get some multilateral kind of legitimacy to certain practices, as Olivier said, get rid of the bad controls and legitimize the good controls. Or just as an aside, the U.S. capital outflows, Fred, correct me if I'm wrong, Fred, I think that in part led to the development of the euro-dollar market. It created the thing. And now, so I am, now this is way beyond my sphere of competence, but I think the whole question of, should Europe reimpose capital controls, that's for the Europeans to decide. But I think the key point is that I think you have to, the point of saying that is to understand the analytics of what went on. That, in Europe draws the line at, free flows of trade and capital are sacrosanct. And then we'll talk about, currency and banking and fiscal as the levers, how much sovereignty you want to give up. But the point is that why not draw that one line before in some instances, I would say, you know, as a non-European, yeah, I mean, some kinds of capital controls perhaps should be on the agenda as a way of making actually the European common market work even better.
Okay, young lady here, and then Bill, and then Colin, and we'll see if we have time for any more beyond that.
Thank you for allowing me to ask a question. Min Xiong with China's 21st Century Business Herald, a newspaper. My question is less to do with capital control, but more to do with the IMF itself. Throughout our conversation today, several speakers have mentioned their frustration and suspect about the politics of IMF. And such frustrations are actually shared by foreign governments, including the government of China. Just this morning, when the Chinese vice finance minister was briefing the Chinese press about the upcoming G20 summit, he again repeated urgency that the IMF should pass its 2010 reform, the reform that will bring China to become the third largest shareholder and cut, I think, 2 seats from the Europeans, from their directors. And we know that such reform has been late. While this reform is facing a stigma in IMF, we see that the emerging countries are working on their own regime of the upcoming international financial institutions. The latest example is the so-called BRICS Bank, which the BRICS summit in March has decided to start a working group and will come up with a report by next year. And not to mention also the Chiang Mai initiative, which now has already become a true monetary fund of some kind. So the question to the speakers is, how much are you concerned that this new generation of international financial institutions are going to marginalize the current system of IMF, World Bank, etc.?
That's a fantastic question. Great, because I think that goes to the heart of some of the discussions we're having. And I frankly think that what you're saying, you know, the whole BRIC Bank and the Chiang Mai initiative, the revival of that and the extension of that, is in part a response or a frustration with the fact that the current international institutions are not responding to changes in the international economic order. And the prime culprit in this is the United States. You know, the 2010 reform, not only is it, you know, it's not even been presented to Congress. So the United States is behaving what I would say like a dog in the manger. You know, it will not contribute to the IMF, and in part it would not let others contribute to the IMF. And the only way this will change is if the US and other countries start seeing what the consequences of this obstructionism are in the form of these things that you just mentioned. So I would say very much that this is not a healthy it's a slightly worrisome development, and the spotlight is on the existing powers, especially the United States, to start revising their outlook and their policies, and to start being more cooperative about letting go of power in these international institutions.
Just very quickly, may I add, I agree with everything that Arvind said, except that I think the blame, speaking as European, I think the blame should be spread.
Oh, absolutely, yeah, exactly, no, absolutely. Europe gets, I think, who is worse in this is difficult to say, actually.
Bill.
I think my primary question is where you get your 15% from. As I look at your operational table, you've got maybe a 30% tax is justified if you expect 100% probability of a sudden stop within the next year. The incidence of sudden stops from the literature is much more like on the order of 10% as a high figure. And in the column on your table, for that kind of order of magnitude, you're talking more like a 1.5% tax. So I don't have the confidence that your 15% tax is the right order of magnitude, and I think it'd be maybe on the high side. I would observe also on China, your own policy would say no outflow controls. And so if you apply your policy to China, Arvind, If you apply your policy to China, I think the effect is more likely to be a depreciation of the currency than an appreciation, because the rule of law is so marginal in China that a lot of people with money would take it out. One final methodological approach. Let me just also say the book misrepresents what I think is sort of the appropriate lower bound in my estimates, which is a 0.5% growth, but that's a quibble. I won't get into that. The broader methodological approach I would submit you consider is the following. We have basic theory that tells us that there's higher return in countries with less capital, therefore there should be gains from capital reallocation just as there are in trade. And as a general principle, it seems to me you have to ask, is there compelling contrary empirical evidence? And let me submit to you, you should think about your own results in the following fashion. You have 3 times as much statistical significant evidence that it's a good thing as you do that it's a bad thing. If you combine underlying theory that says it's a good thing with evidence that says that the odds are 3 times as high that it's a good thing than it's a bad thing, isn't the presumption that the underlying theory is what should guide your policy? So those would be the questions that I would raise.
You want to start with that one?
On the last point, Bill, so it's true that it's 3 times as much evidence for good as for bad, but we're talking about, so the bad is like 6%, therefore the 3 times good is like the kind of 12, 15, 30, 18%, when in fact, to have any confidence that these things mean anything, it should be in the 80 and 90%. That's what the confidence level should be. So it is 3 times a very small number. So it doesn't give me a lot of. And then you say, but then the underlying presumption the theory says is that allocation of thing. But the point is that China would say, sorry, mercantilism has delivered fantastic growth for the last 10 years. So even the presumption that we should that's a bad thing is kind of contradicted by some major pieces of evidence. And in the piece that Raghu and I did for the Brookings, at best we see no correlation between net flows, the current account deficits, and growth. But we find, if anything, marginally that higher current account surpluses or lower deficits are associated with higher growth. So I think that empirically and theoretically, I come down, so interpret the broad evidence as more in saying that that it's not good, not evidence coming down in favor of, certainly not at all being in favor of saying it's good for growth.
Okay, we've come to our witching hour. Colin, I'm sorry, I apologize. Maybe you can grab these guys afterward. But we have hit our witching hour. We need to let everybody go. I want to thank the authors for raising a lot of really very interesting and important questions. I think they've renewed analysis and interest in this set of topics in a very thoughtful way. It's got lots of spillovers into other topics, as we've discussed today. So I thank them very much for it, and view this very much as the start of a very important discussion. Thanks to all. Thank you all for coming. Meeting adjourned.